This is working perfect. Welcome everyone to today's Twitter Space session. These educational AMAs are brought to you by XT Exchange. My name is William. For those who don't know, I'm the head of XT Academy, and of course, as usual, your AMA host. Before I get started in today's topic, just a little bit about XT for those who are not aware. The exchange was founded in 2018 and currently serves 7.8 million users. We have currently about 1 million active users. I've no doubt that's probably going to increase now that the bull market, we're entering the summer phase of the bull market. As of right now, we have about 40 million users in the whole ecosystem, give or take. We have more than 800 tokens and more than 1,000 trading pairs, and that is ticking up every week. So if you have an open account, definitely come check it out. We always have a lot of interesting token listings that you just don't find on any other exchanges until like weeks or sometimes even months later. And that being said, XT has rebranded from xt.com to XT. That really makes a significant milestone since we add a whole bunch of new products. If you guys are definitely interested in that, especially when it comes to like savings, like passive income or staking, or even like cloud mining. Not a lot of exchanges actually provide cloud mining options. Actually, not from my understanding, I know there are a few other exchanges, including like Binance, they actually provide like mining services, like shared mining services, but I've yet to see another exchange that actually provides cloud mining services where the users can actually buy their own machine, but have someone like operate it for them in another country. So if that's something you're interested in, especially like if you're interested in mining, but you just don't want to deal with the maintenance part and the electricity part because it's really you live in the city like me, then that's something you might want to look into. All right. I'm going to just jump right in today's topic. But before I do, just another quick note. We do have the XT Savings product has been fully revised. We have some really interesting and really extremely competitive, if not one of the highest yields compared to all the other exchanges. And the reason being is the company, the XT, the exchange itself, is not taking any percentage of your yields that you're actually earning. They're giving it all back to the users. So if that's something you're interested in, and passive income through savings, definitely check out XT Savings. All right, so let's just jump straight into today's topic. I really want to talk about staking and various different tips that I just learned over the years. And of course, I've made a bunch of mistakes, especially when I started out. And this is specifically pertaining to on-chain staking, because if you're staking through like an exchange like XT, that's totally fine. But like I used to work for a cryptocurrency hardware wallet company, and I'm just a stickler for security. And for like I have friends who actually had like deposit Ethereum on the Celsius, the company in North America, and his funds just literally disappeared overnight when the company collapsed. And of course, I've known a few companies. I know a few CEO who ran companies, and they actually kept a little bit of the cash flow, not all, but some of the cash flow on FTX. And literally, that money just disappeared too. So, like, it's important to be, custodizing your own assets. But that being said, when you do leave funds on your wallet, it doesn't really grow. You want to make sure that you're earning a yield, and that's why I think the very basic way to do so while retaining full custody of your asset is staking. Now, I'm just going to jump right into it. So for those who are not aware what staking is, basically you can earn a yield by locking up your digital assets on a very particular chain to ensure that chain has increased security and stability. That's long story short, but I highly recommend you go read a little bit more about staking, because I want to jump right into the tips, and each of these tips that might take a little bit longer than I expect. So let's just jump right. The very first staking tip that I do want to talk about is diversifying your staking through multiple chains. Now, I understand some of you guys might be thinking, that doesn't make sense. What if I'm holding like all Solana, right? And you want to capitalize on on Solana because it provides a very good ratio for mass adoption, as well as price retention, and as well as that the staking yield, for lack of a better word, the yield, the annual yield is actually not too bad. I think it's around like 6 or 7%, give or take right now. So, but the thing is, and don't get me wrong, I stake Solana, all right, for better, for worse, for however small or large my business may be. I stake Solana, but I also stake a bunch of other things, and the reason being is you want to diversify. Solana has not it has a whole bunch of issues with its own chains due to its success. So I guess you can call that like high quality problems. But that being said, you can't rely on one chain. You can't rely on one chain. It's the same thing as like diversifying your crypto portfolio. As much as I do think that you might want like a bigger position in Solana compared to like say some other layer one chain that allows you to stake but has a much more smaller market cap, you still want to diversify. Even if it means diversifying 4 or 5 different positions. And I'm not telling you that they all have to be equal, right? They don't have to be like 20%, 20%, 20%, 20, 20, right? No, it doesn't make sense, right? Like you want to, if you're more conservative, like, I don't know, like me, I guess, or you are just conservative because, you're staking for a longer term because you're not going to unstake it like every other month and start trading and whatnot, then you want to make sure that you're diversifying, even if your ratios are completely one-sided, and that's totally fine. That being said, you can have something like, I don't know, like 80% Solana, 10% on something else, and another 10% something else. But, if you want to be a little bit more broader, and I think most people would probably be staking something more like 34% in a big, a coin with a big market cap, like, Solana or Avalanche or even Cardano, right? Those are like in the top 15s. And then you can stake you can open up their positions like 15% ratio or 20% ratio in other positions. So you are diversifying, but just because you're diversifying, it doesn't mean that each of your portfolio positions need to be equal. That wouldn't even make sense to me if you did like 20% for each of your positions, because certain positions have more risk, inherently more risk. I don't know, like as much as I love Hedera blockchain, I don't have a huge stake in HBAR coins. I would love to buy more HBAR coins if it drops less than 11 cents. But that being said, I'd rather have a bigger position in Solana or even Avalanche for that matter, because it just have a higher degree of adoption, it has higher market cap. It's just the risk to profit ratio. It just makes more sense, right? But however, you can expose yourself to other positions to diversify your positions, but you just have to, of course, make sure that you are able to move the funds on chain and inherently stake that asset on its own native chain. All right. Before I move on to the next tip, there is like a kind of like a sub tip involved with diversifying through multiple chains. And it's that you do need to take gas fees into account. Excuse me. You have to take gas fees into account. And the reason being is if you're staking, say, some kind of like token on Ethereum layer 1, which I'll get a little bit into later, gas fees can be a little pricey. Now, right now, it's not too bad. Let me just take a quick look at today's gas fees. I think it's pretty minimal. Yeah, it's like 7 Gwei today, 7 or 8 Gwei. That's nothing compared to a few months ago. But like, if you are staking and then you are, say, restaking or unstaking like every month, like sometimes, and if it's not a large amount, the gas fees, concerning the amount of gas fees that you'll have to pay, even if it's like a few dollars, sometimes it just kind of makes your whole like staking rewards a little bit redundant, assuming that you're not staking too much. And for some people, they just aren't, right? So if you are staking, on-chain staking, you do want to diversify through multiple chains, but of course, they don't have to be exactly the same amount. They don't have to be exact same ratio for your portfolio, but at the same time, you want to keep gas fees into consideration. Now, if you already are staking, say, I don't know, like Matic on Ethereum layer 1, and it's pumped and it's great, like then in that case, I guess you don't have to really worry about the gas fees, even if you're paying like $8 or $9 to restake or unstake. But if it hasn't, your pocket hasn't pumped and you're paying like $8, $9 just to restake or unstake or make a verify or prove a transaction, then, and you're only earning what, like $10, $20 a month because your position's really small, it kind of defeats the whole purpose of staking on chain. And that's the case. You rather stake it on a centralized exchange. As much as I do am trying to say that you should be moving like a nice big portion of your positions off chain, on chain, because you have full custody of your assets. It doesn't make sense. Even if you stake, you're not going to make money. You're literally going to break even. So if that's the case, you might as well move that chunk on chain. Excuse me, on your centralized exchange account and just stake it through the exchange. Because this way, when it's done staking, regardless if you want to restake it or unstake it, and just sell your position, you don't have to sell. You don't have to incur gas fees because it's on through the exchange. So as much as I do think staking on chain is really important, you can also take advantage of centralized exchanges and their staking options, because when you stake or when it's unstaked, you don't have to pay gas fees, right? All right, that's a good tip for specifically for people who are wanting to stake small amounts. If you're staking large amount and you're earning, I don't know, say like $200-300 a month, which is a big chunk of money for some people around the world, and your gas fees on layer one Ethereum is like $10-20, I don't think you're going to be concerned about the gas fees. But like I said, some people make staking small, and that's totally fine. But if your gas fees to eat up like half of your staking rewards each month, that you really have to ask yourself, is it really worth it, right? And that's exactly why you also diversify on the multiple chains, like say Solana and Avalanche, which doesn't cost $5-8 just to make one transaction to restake or unstake. All right, hopefully that tip makes sense for you guys. You definitely want to diversify into multiple chains and definitely take into account the gas fees as well as the ratio of how much that you're staking on that particular chain, on that asset on that particular native chain, considering how smaller the risk it is, or in that case, or controversially, how big the risk is. So in this case, your position is much smaller, and then you want to stake a little bit less, right? All right. Another probably good example of this is Harmony, Layer 1 blockchain. Now, don't get me wrong, I like Harmony. Their team, they're a little bit controversial in terms of shit that happened the last few years with them. But what's not controversial is that their bridge from was exploited, excuse me. And that's probably one of the bigger reasons why a lot of their DeFi platforms actually failed, right? Even though the gas is really, really low and the yield for their staking the one coin on natively on Harmony is relatively pretty high. Actually, I'd rather not, because if the bridge was exploited and a lot of developers are not building on there, it really questions you whether you should be diversifying and staking on chain on a very specific chain that actually has very little development, right? So that's a quick example for those who are interested and try, so you guys understand how to really diversify in certain aspects. In certain chains, even though you have great yield, you might not want to diversify and stake it on chain because they don't have developers developing on it, and the projects who did develop on it have all failed. Like Tranquil Finance is probably the prime example for Harmony. Hate to say it, I love the project. I mean, they're a fork from, I believe it was like Compound, about version 2, but yeah, unfortunately, because of the hack, they lost some money, and now Tranquil Finance is out of business. Yeah. All right, let's move on. My second tip is compounding rewards. Now, you're probably thinking, William, this is obvious. Of course, I understand compounding. If I earn $5 and I add that to my stake, obviously what I'm staking is not 100 coins, it's 105 coins, because I have 5 more coins, and then my 105 coins actually earn more than 5 coins the next time, and that compounds over time. Yeah, that's no-brainer. However, here's the kicker. When certain chains, they allow you to automatically compound your rewards, but not every single chain that allows you to stake does that automatically. For certain assets, you actually need to manually compound by manually restaking. So a probably good example of this is Cardano. I think it's one top 10 assets. The cool thing about Cardano, I'm not trying to shill, but I do like one of their staking features, is that they automatically compound your staking rewards. They count your staking rewards into the total balance of what you're staking. So let's just say that you don't check your Cardano wallet, and like I don't know, like a big chunk of your assets are staking on the Cardano network. Well, guess what? All those staking rewards you've earned in every single epoch, even if you don't check it for like I don't know 3 months, 4 months, 6 months, a whole year. Well, you should be checking at least once every few months. But let's just say you're busy and you don't check it like for once every 3 4 months. Well, guess what? All those staking rewards you earn through Cardano, they're automatically compounded. So you actually earn through the rewards in the next epoch, right? Of course, you have to withdraw your staking rewards to count it as your main pool, but it automatically compounds, which is amazing. Conversely, probably another good example that shows the problem with certain assets that doesn't let you compound is the famous um, Polygon. So for those who have ever know about Polygon, when you right now they haven't done like the whole like new like token deployment yet. Excuse me, but right now, in order to stake Polygon, you need, of course, we call them the Matic tokens. You have to stake them on Ethereum Layer 1 chain. Now, here's the kicker. You need to manually stake, of course, but you also need to manually restake. Yes, that costs gas fees. And yes, if your gas fees cost more than the amount that you've earned as rewards, then obviously you probably want to wait a little bit longer, probably like 1 or 2 months or three months before you press the restaking option and incur gas fees, right? But the problem is you won't be able to compound your returns because you need to manually do so. So you're probably thinking, okay, well, why don't I just log in once a week on a Sunday on my day off, and I'll just restake it manually? Well, you guess you could, but like I said, here's the problem. If you're not staking a big amount and you're not earning, I don't know, like at least $100, a few $100s a month, well, restaking every week would actually cost you like a good chunk of pocket money. Probably, let's just say it costs you $5 6 per transactions, and then if you do it every week and there's 4 weeks a month, that's going to cost you $20. Now, for some people who live in first world countries, that's nothing. Hey, whatever, I'm earning like hundreds of dollars through passive income, then $20 is nothing. But guess what? Some people live in second world countries, third world countries, and $20 is a lot of money. And for those who are staking Matic on Ethereum Layer 1, and you're not earning too much rewards because your staking position is small, then guess what? Restaking every week and incurring like a $5 transaction fee could actually be more than what you're earning. So that's why being able to automatically compound your rewards is a big feature for those who don't really trade and are just trying to earn passive income through staking on chain. So if you're looking to diversify your portfolio and you are looking for a new asset and you just want to like place it, leave it, and check it once every 3 4 months because that's you're busy with your life, then you might want to look for assets that allows you to stake and also have this automatic compound feature that really does add a lot. It's great. So don't just blindly look at the APY, although APY is important. So that's why I don't get it. Like a lot of people, when they don't understand, they look at the Cardano staking APY. It's like, oh, it's so much lower than Avalanche and Solana. I'm not going to touch it. Well, guess what? Like Cardano has its own features too, and I think that their automatic compound feature for their staking rewards, I think that's a great thing. So something to keep in mind. All right, so that's my second tip. All right, definitely look into certain chains. They just don't let you compound your rewards, and so if they don't, you might want to be aware of that before you buy the asset and move it on chain. All right, let's move on to my third tip. And my third tip is the lockup periods. Every single different chain, when you stake it on chain, you're probably going to be happy until the day where you do want to unlock it and sell. Let's just say that you bought a whole bunch of Atom coins, right? Because you love the whole Cosmos ecosystem, and you bought a bunch and you moved it to your address, and you're staking and earning. I think Cosmos has amazing yield. It's like 18% or 16%, something like that. So the emission's pretty high. That's probably explains why their price action can be a little bit lackluster, but I don't want to get off topic. And then you realize, oh my God, Cosmos is up 10%, 15%. You know what? I'd love to sell a little bit of my staking position. And then when you go on chain to unstake it, you realize, oh my God, Cosmos takes 21 days to unlock your staking positions. How amazing is that? And then now you're hating yourself thinking, well, by the time this unstakes and I move it to an exchange to sell it 21 days later, it's probably not going to be the same price as I want to sell it now. So you really need to be highly familiar and check the lockup periods so you can stay on top of this, right? So if you know that it's going to take 3 weeks for you to unlock your atom, and you're looking at the, I don't know, like the weekly atom chart, and you're thinking, okay, well, you know what, I need to go on a vacation with my friends, or I need to put a down payment for a car like a month later. I might, and I think I need a little bit of my assets on, because I'm staking atom on chain. I might want to execute my unlocking transaction now, today, because it's going to take 3 weeks, right? So you really need to look up the lockup periods, and it affects a lot of people, right? Every different blockchain that allows you to stake have, of course, different lockup periods. Some do not have the cooldown time. I'm going to get into that. I'm just going to give you a few examples. Like Near protocol, it takes 4 epochs. I think that's about like 4. If you do the calculations, 4 epochs on Near is about 2 days. Hit up 2.5 days ish, but usually 2 days. It's not bad. 2 days is nothing compared to experiencing a wait time of 21 days on Cosmos. I remember not checking that many years ago, and I realized, oh my God, it takes 21 days to unstake my Atom tokens, my Atom coins. That was just so painful. I couldn't believe I made such a mistake. For those who don't want to wait that long because you want the ability to sell it, you definitely want to probably be keeping your DOT coins on your exchange. And the reason being is Polkadot takes 30 days. It takes 28 days to unbond, and then it takes another 2 days for Wealthsimple to complete your unstaking process. That's 30 days in total. I'm no joking, guys. As much as I think of Polkadot and their parachains is great, technology and the architecture is amazing, and I love it's really ideal governance model. I think it's a little bit too ideal, a little bit less practical, but hey, that's just my opinion. I do think that this whole 30-day unlocking period is absolutely insane when you compare it to other chains. I mean, just look at Solana for even. That's like, it takes 1 epoch to unlock your soul coins on chain. And that's about like, what, 2 days? I believe it might be 3 days, excuse me. But that's not bad. 2-3 days compared to 30 days or even 21 days, that's no brainer. But here's the kicker. Not that I don't want to shill Cardano, but I do want to point out that Cardano only takes a few minutes. And the reason being is because there's no cooldown time. There's no unlock period for a Cardano. How cool is that? Now, it does take a few minutes for the transaction to go through. They do use a UTXO model, unlike the accounting model Ethereum, Solana uses. But there's no cooldown time. So just wait a few minutes, your transaction goes through, and voila, you can move your ADA coins to an exchange and sell it on the same within the hour, right? You don't even have to wait for a day or even 2 days. It's just amazing. So if you want to say extremely liquid, I guess that's something you might want to look into. Though I think waiting a day or two, it doesn't really hurt. If you wait 21 days, or even 30 days, like Cosmos and Polkadot, and you're trying to sell like near the top of the whole bull market, I have a feeling that you might just miss your opportunity. So something to keep in mind. This is another reason why, I think it might be wise to keep certain amount of your Polkadot or Cosmos position. So for those who own DOT coins or the Atom coins, you can leave a portion, not all, but you can leave a portion of it on your exchange account and just save it through the exchange. And the other half, for security and, of course, custodial reasons, just leave it in your wallet and stake it on chain. So this way, you don't have to worry about rushing to your wallet on execute the unstaking process and then wait for 3 weeks, and hopefully the market stays on, up, and then before, and if it does go drops down and your 21 days are up, you're thinking, oh well, well, I guess I can't sell now, right? Especially if you're in the red. So definitely look up the lockup periods. I think it's really important if you really want to stay on chain, right? And if you guys like Cosmos and Polkadot, just put like, use your Google Calendar and put like a notification in your Google Calendar to remind you 4 weeks before that you need to unstake, right? If you need to buy like a car on, let's say, October 1st, we'll put like a reminder in Google Calendar and just put it like on October 1st, say like, buying car, and then put a notification for 4 weeks ahead of time to say, and it says, your notification says on stake Polkadot for car money, right? All right, so that's what I do. This way you don't forget. But another easy way to do it to stay liquid, or you don't have to worry about the unlock period, is to keep a small portion of those funds on your exchange. Not all, just a sum, right? This way you don't have to deal with like the moving funds to your exchange, and then after it's unlocked, it's sometimes a pain. All right, let's move on. Oh gosh, I'm only on my fourth tip and it's only 30 minutes through. All right, let's look at the fourth tip. The fourth tip is choosing validators. For those who are not running your own validator nodes, sooner or later when you stake on chain, you're thinking, well, how do I choose a validator, right? This is a little complicated. They all look the same. And I remember staking my first time on, I don't know, was it Cardano or was it like Solana? I was thinking the same thing, like which validator should I choose, right? And I had friends who asked me this, so I had to like really look into this. And so there's a few things that that I highly recommend before you choose your validator. And the very first thing that I look for is, do they have a website? That's like, because someone who makes a website, to put the effort in making a website just for your to show that people, to show people who want to stake with you that you are taking your validator business very seriously, says a lot, right? So do they have a website? Because you have to pay for a website, you have to pay it monthly, you have to keep it up, you have to update it. Do they have a website? If they don't have a website, I'm like, yeah, I don't want to stake with someone who just suddenly disappears, right? And next you know, hey, how come I haven't earned yield in the last 3 months? Because I've been busy, I haven't been checking my staking position, right? So do they have a website? Okay, that's a big one for me. If they have a website, and as much as shitty as it may be, it doesn't matter. Do they have a website? Okay, the next one is, do they prove that they provide their validation services for other blockchains too? Now, I think there's nothing wrong for Validate to only validate one specific chain, but there are people out there, especially companies out there, that run validation services. That run their
This space was downloaded via spacesdown.com. Visit to download your spaces today.
own validator nodes on multiple different blockchains. And it shows how serious they are, because they're taking this as a business approach. And that's why they're actually trying to validate for not just, say, Polkadot, or not just for Solana, or not just for Cosmos. They're doing it for more than one blockchain, right? And that really shows me promise. It shows me that they're taking their business seriously. They're trying to diversify their services because they want to make money for different user base. Then it really shows me that they know what they're doing, and that they're willing to learn how to validate various different nodes for different blockchains. So do they provide different validation services for other blockchains? I think that's a really big one. So if you see on the website saying that you can stake your Near coins with them, you can also stake your Solana coins with them, you can stake your Cardano coins with them. It shows me that they're doing this as a business professionally, right? So they're not one person just testing one specific chain because they're enthusiasts about it. And next thing you know, they might even have a team if they're actually validating for a bunch of blockchains. So that actually says a lot. The next thing I would look for is, where are they based? Now, I know that might sound a little bit hypocritical, or it sounds a little bit biased, but hey, I don't want to be staking with someone who's running their nodes in a country that's, I don't know, politically unstable, or who runs their nodes in a country with unstable electricity. So I'm not going to mention country names, but you guys can guess that there are certain countries out there that at certain parts of the day electricity goes out and you don't have electricity. Now, I guess it happens once in a while, but not every day or every other day, right? So when you are choosing validator nodes, you want to look at the website, or the validator website, and check where they based in. Now, if you're choosing if it shows France or Germany or North America, they usually have stable electricity, usually politically stable government, right? You don't have to deal with like you don't want to deal with like any like the nodes suddenly going offline because something happened to the country or whatnot. So that's definitely, you want to check where the validator is based. Where are they running this computer, right? The next thing I do looking for is how long has their team been staking for, right? Are they new to the scene? Is their website says 2024 on the bottom, or are they shown like 2020? So they basically survived the last bear market. I want to see if they're new to this or they've been doing this for a long time. It really shows how dedicated they are, or the team, especially if they have a team, right? So that's something I definitely look for. And the last but not least, some validators, they actually they tell you what exactly hardware they're using and what kind of backup generators they have. Now, this is not a requirement, but like the validators who do disclose their hardware, they try to show you a picture of their server stack, or like their amazing computer they built for the node, or even just like single board computers, and take a picture of them. It shows a lot. It says a lot, especially if they have backup generators. All right, so those are my 5 kind of like mini tips, part of the validator selection. All right, and hopefully that helps you choose their validator. All right, let's move on. And my next tip I'm going to make this one quick because I think this is a little less significant, is your staking pool. So for those with smaller amounts of crypto, I think joining a staking pool can definitely be beneficial, especially if you want to stake your Ethereum, because who has 32 Ethereum, right? Like, it's worth quite a big chunk of money for the average person. So staking pools really allow multiple stakeholders to, of course, combine your resource together to make, of course, in this case, 32 Ethereum to of course increase your chances of course validating the blocks, and then as a result earn the rewards, right? So you can use like platforms like Rocket Pool, or even like Lido Finance for Ethereum, right? For of course multiple different assets, right? Not just for Ethereum. And this really makes like staking a lot more accessible and of course profitable for smaller investors like us. All right, so that being said, hopefully you guys can take a look into staking pools, and especially if you want to stake like say Ethereum, I think that's really helpful. All right, let's move on. I think we definitely want to look into security measures, especially when we're looking at who we should be choosing to stake our position. And I think I guess I should have like added this into like the validator selection, but I think like I purposely kept it to separate tips because this is purely regarding security in terms of on chain sharing in terms of data. So the thing that I definitely always look into when I'm choosing validators is, even though I do think that like, oh, they're based in France, it's safe, and like they're pretty safe because they have a good reputation. If their amount that they've been staking themselves as a validator is extremely small, and you see like a whole bunch of people staking with them, I would start being a little bit concerned, because they can literally pull their nodes offline. They only lose a small amount of money. What if someone stakes a whole bunch of coins with them and they only have something small to lose? So if you see a validator staking a much more bigger amount, it says that like, look, if they're a bad actor and they act badly on and try to like sabotage the network, they have a big chunk of money to lose, which shows that it's a lot safer and a lot more secure to stake it with a validator who actually staked a lot themselves, right? So if the validator has a lot to lose, then that most likely they don't want to F up. So even if you're going to stake like a small chunk of coins with them, that most likely they're going to take their position seriously because they don't want to lose that big chunk of money. All right. The next thing that you want to look in terms of, for just as a security measure, is of course the number of stakers staking with that validator. And if you see like, they stake a big amount themselves, but you only see them a few people staking, it really makes you curious or even wonder why not a lot of people staking with them. Is there something wrong with their validation process? Are they missing blocks? Are they unstable? If their computer unstable? Like, it makes you ask a question. So you want to check if they could literally just be a good validator. No, this might be a good option. Maybe it's just bad marketing. Who knows? But the possibility is maybe they're doing something wrong. So you definitely want to look at the statistics, especially how many blocks they have missed to validate. Now, if that percentage is low, that might explain why people don't want to stake with them, because you're literally missing out on rewards if that specific node is not validating all most of the blocks, 99.5% of the blocks. And if you miss like a block, okay, stuff happens, right? It doesn't have to like if it's not 100%, it's no biggie. But if you miss like a, a few, like if you miss like 10% of blocks, it makes you start to wonder, well, what have you been doing for the last 10% of your node? Why is it offline? Why have you missing these blocks for 10% of the time, right? It's odd. And last but not least, I think that as a security measure, you definitely want to check if I kind of guess this is related to their website, but you want to check how active they are on Twitter or X.com, if you want to call it, right? So if they're active on Twitter, it says a lot that they are engaging the Web3 community. They are part of a very particular part of a blockchain community, and they are there for the long term. Now, if you see that they have a nice website, but they don't engage online, well, maybe they're just running passive income. That's totally fine. But what if something like there's an update? What does that says that they're disassociated, they're not really following up with the community, and that they don't know what's going on, and thus they will not be able to update their nodes properly, because you have to manually update them at times, right? So if they are active on X.com, or in this case Twitter, you actually know that they're following up with what's going on, especially with the governance, and then they actually have to update their nodes, especially when you have to do it manually, and that says a lot about the person who's validating that node. All right, so hopefully those 3 security measure tips really help you guys. Of course, I'm just going to quickly rephrase. I just mentioned one more time, it's the amount staked by the validator. And you want to check the number of people staking with the validator. And then last but not least, how active they are on social media, specifically Twitter. So this way you know for sure that they'll definitely take care of stuff, especially the node updates, the manual node updates, when that actually does come about. I've actually personally have to unstake my certain crypto positions with specific validators, because they are sleeping when a manual update is required. And I'm just like, yeah, I don't want to deal with that, because you can easily miss a whole bunch of blocks and you're not really supporting the chain. All right, let's move on. All right, then my 7th tip for today is, of course, staking rewards variability. Yes, I know I'm kind of being a little niche here, but at the end of the day, the reason why we stake is to not only support a particular blockchain and the stability of a blockchain, but let's be honest, guys. We want our money making money for us, all right? We want passive income, all right? But that being said, sometimes sometimes you just need to jump ship to another chain and stake it with someone else. Or sometimes some people just want to micromanage their staking positions, and I'm going to exactly show you how you can slowly jump ship, because sometimes you can't jump ship from one particular position, because let's just say you bought something for $1 and now it's 80 cents, but you're staking it, and for sure sooner or later we're going to go through a full-on blown bull market summer season, and then we're going to have the alt season coming on, and then you're definitely going to go above $1, so you can totally be able to sell your position then. Well, what are you going to do until then, right? Well, guess what, guys? What you guys can do is, first, of course, you check the price action, right? And you're looking, okay, this asset I'm staking right now, it's really lackluster in terms of price action. I bought it for $1, and let's just say because for some reason it's 90 cents, it's 80 cents. It's not worth selling right now, right? Because you'll be in the red, obviously. So, and you're looking, okay, well, it only gives me, say, 3% staking yield. So this sucks. So what you do is you find another coin with, of course, a higher yield and good price action, right? So once you find another, let's just for example person, you're going to buy Solana, right? Solana right now is about I think around 7% APY. So 3% to 6% is a big difference. You basically double your yield, right? So let's just say, okay, you chose Solana. So right now you're looking at in the market conditions, and you're thinking, okay, well, maybe in the next 3 days, I do expect a small pullback. So what you do is you sell your coin A with 3% APY, right? You sell it right now. You wait for Solana to pull back. You buy Solana. using your staking rewards that you just sold, not your original position, just your staking rewards, right? You can just do this like once every 2 months, 3 months even. You sell your staking rewards with Coin A because you expect Solana to pull back next 3 days. And then when Solana pulls back down, maybe, I don't know, a few percent, you buy, you buy a Solana coin using your staking rewards, your USDT derived, your USDT that was derived from your staking rewards. And then once your buy orders is triggered, you move Solana to your, of course, you move your Solana to your wallet, and you stake Solana. And there you go. You can literally do this every month, but if it's not viable every month, you can do this literally every 2 months as a way to manage your staking yield. So this way, you're actually slowly converting your staking rewards to another without touching your initial investment, because right now your investment is in the red. In this case, you don't want to pull out when it's in the red. Obviously, you want to lose money. We're here all to make, it's a financial management. You want to make money. You don't want to lose money. So you leave your initial investment in, especially if it's in the red. Now, if your initial investment's in the green, yeah, sure, you can do the exact same thing, but just move your whole unstake, move your whole position to the exchange. Put in your sell order. Once it's triggered, you make it like an extra 1%, 2%, whatever. And as long as you're in the green, you sell it in the green, and then you wait for, say, let's just use the Solana as an example again. Solana dips another 3-4%. You buy it up or as low as possible, and then you move it on chain and you stake it that way. And actually, instead of earning 3% yield, you're earning 6%. Now, for those who are in the red, staking a specific asset, and your initial position is still in the red, you can just sell your staking rewards once a month, twice a month. It really depends on how much your staking rewards is, right? You sell it, and then you wait for the dip, you buy Solana, and they move on. And that's assuming that, your current yield is 3% and Solana's is 6, like a double or more, right? So that's something you can do. I think that just because one asset has higher staking rewards, it doesn't necessarily mean like it's a better option. However, if you do want to maximize your yield, especially right now, if you're looking at your asset and the APY, staking APY has decreased in the last few months, or since the last you checked, dramatically decreased in the last few months, then this is a strategy that you can do, especially if the price action is lackluster and you're in the red. You can just sell the staking rewards itself, use the USDT, buy the dip of something better, and then stake it like that until your initial position recovers. All right. So hopefully that's clear enough, guys. Hopefully that gives you guys like a strategy to, maximize your yield without going into selling something in the red. Okay. And last but not least, okay, wonderful. I'm on time. Well, last but not least, if you definitely want to check whether in order to earn a yield through a specific digital asset, whether you need to participate in on-chain governance for your yield optimization. Now, I think a good example of this is Algorand, because Algorand, they used to have this really interesting password staking rule. I love Algorand back in the day. It's past tense. And the reason being is when you actually have algo coins, algo coins, you move it to your wallet. And the cool thing is you don't have to do anything. You don't have to choose a validator. You don't have to execute like a staking transaction. You don't have to restake. You don't have to unstake. The whole staking architecture mechanism built in Algorand, they used to be built into the staking rewards program or Algorand, was automatic. It was so cool because basically once you move your algo coins to your wallet, the blockchain would keep track exactly how much algo coins are in that specific wallet of yours. And what it does is every epoch, you would automatically receive more coins allocated to your wallet. How cool is that? That's like literally you move it to your wallet and you don't have to do anything. You just get money, right? Your position gets bigger. Unfortunately, though, as of right now, I believe I think it was 2022, April 2022. Algorand, unfortunately, they changed their whole staking rewards program. Like right now, you actually need to participate in their new government's rewards program. So basically, you had to vote and choose this, and then of course there's different voting sessions. Sometimes it's active, sometimes it's not active, so you can't reward. So you have to put it in your calendar for the next voting right for excuse me the next duration that's going to pop up. And if you don't vote, here's what bothers me. If you don't vote, if you don't participate in on-chain governance, you don't get staking rewards. And I don't know about you guys, but for those who love to engage in on-chain governance, you guys really love the Web3 and stay engage and really participate in all these amazing governance. I think that's great. I'm just busy. I'm really busy. I just don't really have the time. I love to participate in Algorand, on-chain governance, but guys, it's just life sometimes just keeps you busy, especially and I do a lot of DeFi for that matter. So that really takes up my time. So I don't really have time to participate in on-chain governance just to earn a little bit of passive income through Algorand. Because if that's the case, I might just swing trade, buy today and sell 2 days later. It's less stressful for me that way. I'll make a lot more that way. So, but that's me specifically. There's nothing wrong with participating in on-chain governance. I think that's great. But for those people who prefer more a passive method, to earn passive income through staking, you definitely want to check if there's certain things you need to do in order to earn your staking reward. And sometimes blockchains, they change that criteria, just like Algorand in 2022. All right, so I'm not trying to badmouth Algorand. I think they're doing a great job. I think they have great technology. I really do hope they get more adoption because the person behind Algorand, some kind of I think he's a doctoral professor in excuse me in what's the word I'm looking for? Brain's not working anymore. In coding, it's not coding. It's specifically some kind of it's in God, my brain's not working. I'm so sorry. Anyway, so that is the to definitely go check an Algorand. I think it's still pretty cheap compared to Cardano. Unfortunately, I don't know why, but their price is a little bit lackluster. I think it's because they might have been losing out on a lot of people who want to stake using their funds because they used to be amazing. The price action was great, but they unfortunately lost this passive staking rewards. All right, guys. So that's my 8 tips for today. If you guys have any questions or concerns, feel free, related to today's topic, feel free to put up your hand and I'll pass the mic over. We have a few seconds. We have a few minutes. I can definitely answer your questions. So just ask for the mic and I'll be sure to pass it over. Let me just quickly see who's asking for it. All right, so Fefi, I did see that you requested for the mic. You have the mic. You can ask your question.
Hey man, good day. Can you hear me? Hello.
Yeah, I can hear you. Go ahead.
Okay. There are a lot of crypto projects providing staking feature nowadays. But how to select the best project which is providing the staking feature, and how to trust those projects? What are your suggestions to select good quality projects to stake our assets?
Okay. I think I can address a certain part of your question. Because at the end of the day, of course, these educational MAs are for educational purposes, they're not financial advice. But that being said, I would highly recommend everyone to check out a very specific website. It's called stakingrewards.com. And it's basically a explorer that shows you multiple different blockchains and how, and they all include they only include blockchains that allow you to stake their assets natively on their inherent native blockchain. So it's stakingrewards.com, STAKINGREWARDS. And if you go to the website, you actually see that all these different they show the top staking assets, and of course a whole bunch. You can actually calculate your staking rewards. You can choose the asset. Of course, you choose the provider because every provider validator has different yield, right? And then you can write down, input exactly how much amount that you want to stake, and you can actually see how much you would earn after, say, 1 year, or you can literally put in the amount of staking time you want to do it, like exactly down to like what the amount of years, the number of days, the number of months, and you'll actually see approximately how much funds you'll earn. So that's how I would actually address part of your answer. Other part of your answer is after you see exactly which chain provides native staking on their own, of course, native in blockchain, then I would actually start comparing their reward rate, and of course I'd check out the market cap, and I just want to, and I'll definitely check how many developers are developing on there. Or else I'll definitely check out like recent. I'll also check out their roadmap. And now, unfortunately, I won't be able to tell you like exactly which ones that I recommend, because at the end of the day, guys, this is educational AMA, not financial advice. But I highly recommend. That's what I would do. And especially for a beginner, I think those are like very simple ways to help you guys choose for yourself, especially to stay a little bit more conservative in your choices, because it's just safer that way, especially if you're new to this. So definitely would check out the rewards rate, and of course the market cap. But of course, it also comes down to like how long you plan to stake for it. If you stake it on like an asset that has really big market cap, well, technically you probably don't have to worry about it not surviving the next bear market, right? So you know it's probably here for the maybe not perpetually, for at least for the next 10 years, right? So you can stake and forget, right? Especially if it has automatic compounding. If it doesn't have automatic compounding, as suggested earlier, obviously you have to like come back and restake every like few months, or at the very least like once or twice. I'd recommend at least once every like 2 months. But like I said, it still depends on like your duration, right? So certain like chains, you can actually like Avalanche, you can set the amount of time, the duration that you want to stake, right? So you can literally stake for like 6 months, and it'll automatically complete its unstaking process automatically for you. For some chains that don't, you kind of have to like restake your staking rewards manually, right? So you definitely want to look into those. So it comes down your time horizon. If you want to like unstake and have access to those staked assets for your cash flow, then you want to be able to see something with a very short unstaking period, right? And if you're something who are in the long run and you don't mind staking throughout the whole like bear market, or unstake a little bit and sell during the full market, but continue staking the other portion that you haven't unstaked, then you might want to look into something that's prioritizes, that actually has automatic compounding feature. So this way you don't have to, you can just leave it and it'll go, because you're totally fine long term. So it really comes down to like how you want to manage your position. I do think that if you do stick to like the top 20, 25 options, I think you are safer in that way. But at the end of the day, unfortunately, I can't tell you exactly which positions to buy. But hopefully that gives you the right direction, gives you the right information to help you choose the right asset to stake on chain. I believe we'll be wrapping up. I do appreciate everyone joining in today's AMA. Hopefully you guys learned a lot. We will definitely have another AMA this late evening today with Web3 Project. So definitely stay tuned. I'll have another interesting AMA every Friday as usual. The Friday AMA is the weekly technical analysis and fundamental analysis AMA. So if you want a quick update of what's going on with the market, and should you be buying, should you not be buying, you want a second opinion, or what kind of assets I should keep my eye on because something interesting just popped up, you definitely follow us on Twitter and definitely join us our AMA this Friday. I'll be sure to share my insights then. Thank you very much everyone for joining. It is always a pleasure, and definitely stay curious and keep learning, guys. Have a good one.